So Bill, tell us about the underlying structural position of the budget. Now that you've got the first budget out of the way and you can see what's inside the innards, if you like, of the government.
Well, I think the best measure of that is that the budget says it'll take us 10 years to get back to surplus. Now that looks like a fairly demoralising trudge to get to where you've got some significant choices. And the reason it takes so long is because, particularly since about 2005, government expenditure really took off. In fact, it was growing at twice the rate that tax revenue was growing. So now when at that rate of growth with tax revenues dropping, there's quite a big hole. Now, New Zealand, we've been here before. Back in the late 80s, early 90s, New Zealand had a series of deficits. The difference is that what happened then was there was significant asset sales, and so the problem was solved by paying off debt, getting the interest costs down, and that got us into surplus. We don't have that option now. There's not near as many assets to sell. The government's not selling them. We're actually got a net income from interest because we've got more assets than debt at the moment. So the underlying fiscal problem is simply entitlements and public services are costing a lot more than the revenue that's coming in.
So how do we fix it? What are the options?
Well, we're taking a longer term view about it. So instead of a sort of smash and grab savings program, we've done a budget where we took the easy stuff, which was loose ends left over by the last government. There was a few $1 billion of savings there. And now we're saying to the public service, right, the next 3 to 5 years you'll get no new money. So you've got 12 months where you're getting a reasonable inflow of cash from this budget, helps through the bottom of the recession, keeps the economy ticking along. But that's an opportunity to think about how you are going to fundamentally reorganise delivering your public services, because they used to a lot of new money each year. Now we're going through, focus on the big exposures on the government's balance sheet, the big cash flows, what we can do with those to contain the growth of government. So we want to provide smarter, better services with the same or less money.
So that's on the spending side. What about on the income side, though?
Well, we haven't really, on the income side, all the discussion, of course, for the last 5 years has been about tax cuts. Well, that window has now slammed closed because revenues are dropping much faster than anyone ever expected. And the issue looking forward, so it means we've got to make quite a quick shift in how we view the tax issue. I mean, these are pervasive incentives in the economy. We need, if we're going to avoid tax increases, then we need a very efficient tax system. Many developed countries will be putting taxes up because their public finances are in such a mess, the US and the UK being obvious examples. So we don't want to do that, but there is beginning now a discussion about whether the current mix of taxes is the right mix between GST, income tax, capital taxes.
So what is an efficient tax system then? What might it look like?
Well, the briefings to the incoming government covered this territory, as is the current Henry review in Australia, which is pretty interesting because they're doing a first principles look at their tax system, and we're going to have to be very careful we don't get caught flat-footed if they do some sexy stuff, which makes them a much more attractive destination for people and investment. So the kind of issues that they're looking at are that the tax bases that don't move are consumption. So should they have higher consumption taxes? Land doesn't move. So should you have land taxes or some kind of capital gains tax? And the trade-off being that you drop income tax and company tax because companies can move very quickly and so do people. And that's, of course, a big issue for New Zealand.
John Whitehead talked about the issue of capital gains and lands tax as something like to bring people out with pitchforks and flaming torches. How does a national government deal with this issue of capital gains and lands tax?
Well, we just haven't dealt with it because we haven't really considered it. John Whitehead mentioned it. Actually, he didn't get chased down the street with pitchforks, much to his surprise. And it's been around, I mean, the issue's been around for a while because people have been concerned about the last housing boom and rural land farm price boom, which was even bigger than the housing boom, and both of them have come to grief. So that's why it comes up. Is there a way of shifting investment to more productive investment and less real estate? Now, there's a tax working group being set up. They're starting to talk about this. Next week I'll be talking to Wayne Swan, the Australian Federal Treasurer, just to get a measure of how far they think they can go. They're probably 12 months ahead of us on policy work. They've got an election coming up, no doubt, but it's possible that after an Australian election, whichever government is there, could be doing some radical things on tax, and we'll have to keep a very close eye on that so we don't lose competitive advantage.
Is there anything from your point of view that's off the table?
No, actually, we've explicitly said to the tax working group here, we don't want to rule anything out. We need to restore a bit of free thinking in New Zealand, where the politicians don't completely dominate the intellectual discussion. But the challenges ahead of us around getting a shift from consumption and borrowing to exports and investment, to get a better savings culture, to get higher productivity, they're very large challenges, larger than I think anyone realised just 12 months ago. And so we can't rule out anything. It doesn't mean the government's going to agree with it. I mean, capital gains tax, I'd find it pretty hard to win an argument with the national-led government about it. But let's have the argument and then settle it and then move on.
And time frame, you're thinking within the 3 years, or is it something longer term than that?
Oh, I think any significant tax shift is probably a longer term program, but we haven't considered time frames at all. I mean, this is very, very early stage, but I am keen to get a measure of the temperature in the Australian work, because we can't afford to be behind. Ideally, we'd be ahead of them. We certainly can't afford to fall a long way behind them.
A lot of our readers have money in term deposits and debentures and banks, and I wanted to know what's happening with the government guarantee.
Well, the government guarantee, as we know, expires in October. We're going through a fairly thorough work program right now so we can make some statements to the market before too long about what's going to happen, because clearly the closer you get to that date, the more the distortions are building up. There's an extra challenge in here. One is what the government should do about the end of the guarantee. Between now and then, though, there's an additional challenge, which is the non-bank deposit-taking regulation regime coming in. And so all those institutions covered by the guarantees, the non-banks, need to be having a hard look at whether they're going to be able to reach the thresholds that the Reserve Bank is setting for capital requirements and liquidity requirements. So it's tricky territory. The aim for us is to minimise government intervention but also minimise any instability in the finance system. So there's a few important judgments to be made in the next few months.
Because we're getting quite close to that period of 2010 and October 2010, and there's quite a few finance companies thinking we have to make a decision up pretty quickly. What sort of time frame are you looking at?
Well, look, I wouldn't want to put a time frame on it today, other than we understand the need for clarity in the market. For those finance companies who are concerned, they've got the hurdle of the Reserve Bank requirements to jump. We would be hoping to see some significant reorganisation in that sector. And we'd rather see finance companies proactively shoring up their position rather than waiting around to see whether they can play some kind of daredevil game with the government.
Because that's a risk. The trustees for the debenture holders could say, maybe we should pull the plug before the guarantee comes out so that we can be sure the debenture holders get their money, at least from the government. Well,
that's possible. There's also the opportunity for mergers and acquisitions. There's no doubt if everyone just sits around waiting for something to happen, that may not work as well for depositors and for the owners and managers of these companies, as understanding that the world is changing. There's a new regulatory regime. The deposit guarantee scheme is it's uncertain just what's going to happen to that, and being proactive would probably help everybody.
And just finally, looking at the area of bank interest rate margins, there's been a lot of noise. The Finance and Expenditure Committee has come out with a report. The Reserve Bank has come out with its own analysis. What's your view about whether the banks need to be forced or not forced to reduce their margins, particularly for those floating mortgage rates?
Look, I think it's important to see this issue in the longer term. Two things matter here. One is stability and profitability is pretty important in your banking system, and we're benefiting from that. If banks stop lending, as they have in other countries, people lose jobs, businesses go under, public finances blow out. So financial stability is really important. I think the other thing is that in the long run, all the indications from the discussion around the world about banking regulation is that banks are going to be pushed into more of a utility type model, where they will be running lower risk profiles and making lower profits. I think the Australasian banking system has a pretty robust view that they're going to keep making a lot of money, and they damn well should. Now, I think public pressure and political pressure is bound to grow around that. In terms of the detail, I think you can argue credit card rates are still too high. Business rates, even for sound, profitable businesses, haven't moved much, even though the cash rate's dropped considerably. And of course, the floating rate does look a bit too high. But at least there, people have the choice of going on, say, a 6-month fixed rate, which at the moment is lower than the floating rate. So customer pressure, I think, is going to build up. Political pressure and regulatory pressure is going to build up around the banks. And in the long run, they'll be less risky and less profitable.